Good morning, distinguished guests, speakers, panelists, ladies and gentlemen. A very warm welcome to today's seminar, jointly organized by AMRO, the Economic Society of Singapore, and ASEAN Business School. Thank you all for joining us this morning. We are pleased to have you with us for this discussion on the ASEAN+3 regional economic outlook, with a focus on ASEAN's resilience and the growing global uncertainty. Today's seminar will begin with opening remarks provided by Mr. Manu Bhaskaran, followed by AMRO's presentation on regional economic outlook. We will then move into the panel discussion and Q&A. To begin, it's my pleasure to invite Mr. Manu to deliver the opening remarks. Mr. Manu, please.
Good morning, everyone, and let me just add my welcome to this Economic Outlook seminar. First of all, I'd like to thank ASEC and James for hosting us. I think it's the third time we are collaborating, and we look forward to further collaborations between ASEC, AMRO, and ESS. We're meeting at an extraordinarily difficult time to make any predictions about the economic outlook. One tweet from a certain individual can change a lot of things. But AMRO has updated its outlook, and I think there's some really interesting features in the report that they issued, not just on the immediate outlook, but also the very detailed work they've done on trade linkages, which I found very interesting. So without any further ado, let me hand back to the MC, and hope we have a productive session. Thank you.
Thank you for your opening remarks, Manu. We'll now move to the presentation segment. It's my pleasure to invite Mr. Hao Bin Wang from AMRO to present the key findings from this year's RO. Hao Bin, please.
Okay, good morning, everyone. So I just speaking without the mic, I guess it should be. Thank you for joining us today. So today I will share with you the key findings from our latest flagship report, RO 2026, which was just published last month. The theme for this year's report is navigating headwinds from a position of strength. Let me first quickly walk you through let me quickly walk you through the roadmap for today's presentation. So I will start with a brief introduction to AMRO for those of you who may not be so familiar with us. I will then move on to the near-term outlook for the region, focusing on the impact of the Middle East crisis and the energy shock. After that, I will discuss a more longer-term perspective on the region, focusing on the transformation of trade and investment linkages and how it imply for the region, before closing with ASEAN integration and how we can further push for deepening of regional integration. So first, a little bit about AMRO. So we are an international organization set up by the central banks and finance ministries in the region. Our member economies include all the ASEAN members, as well as China, Hong Kong, China, Japan, and Korea. That's why we call it ASEAN+3. Our core mandates include conducting macro surveillance for the region and supporting regional financial cooperation, including the Chiang Mai Initiative multilateralization. We also provide technical assistance to our member economies. In addition, AMRO also serves as the secretariat for part of the ASEAN+3 finance process. We also serve as the regional knowledge hub. In terms of publications, we have country-focused reports. Every year, we publish an annual consultation report on each of our member economies. We also have more regionally focused reports, such as the REO, which I will cover today. We also have two other flagship reports focusing on fiscal and financial stability issues. Now, let me move on to the near-term outlook for the region. So the core message we want to get across here is that the region entered this energy crisis from a position of relative strength, but downside risks have materially risen. Let's have a look at the region's growth performance in 2025. So growth in 2025 came in stronger than expected at 4.3%, well above the 3.8% that we forecast right after the Liberation Day. This basically reflected lower effective tariff rates than initially announced, as well as very robust AI-driven semiconductor demand, which lent a support to regional exports. Domestic demand also provided a firm anchor with robust household spending and also strong investment activities thanks to the surge of FDI inflows into the region. But one less appreciated point is that intra-regional trade also strengthened after Liberation Day, even as our exports to the US softened. Trade within the region grew by more than 10% actually after the Liberation Day. And this was genuinely two-way expansion, with China's exports to the rest of the region and also the rest of the region's exports to China both expanding significantly. While this strong outperformance in 2025 gives the region a useful buffer, we do expect growth to moderate heading into this year and next. Growth is forecast at 4% in both 2026 and 2027, while inflation is expected to rise to 1.4% this year and 1.5% next year. However, this baseline is subject to huge uncertainty going forward. The main uncertainties are the energy shock, the trajectory of the technology cycle, and US trade policy. Overall, risks are tilted to the downside. Let me now turn to the most immediate risk facing the region, the Middle East conflict and its impact on energy supply. We know that the severity of an energy shock really depends on two things, the scale and duration of the shock. On scale, this is perhaps the most significant disruption the region has faced in decades. We know that about 20% of global oil and gas trade flows through the Persian Gulf. This is about 4 times the supply affected during the Russia-Ukraine conflict. The macroeconomic impact really depends on how long this conflict is going to persist. A prolonged conflict could push cost pressures well into industrial inputs, logistics, food prices, and services. Because of this uncertainty, we also consider several scenarios around the baseline. So under the baseline itself, we project oil price to remain above $90 per barrel through June this year, and will gradually trend down to $75 to $85 in the second half of the year. However, in a more adverse scenario, oil prices are projected to remain above $100 per barrel for the rest of the year, which now looks like a possible scenario. Under this scenario, inflation could actually rise to 2.2% for this year, and growth could slow to 3.7%, which represent the highest inflation and slowest growth since 2022. Now, the energy shock may be the most immediate risk, but don't forget it's not the only risk we are facing. Technology cycle is another two-sided risk. AI-driven technology upcycle was an important impetus to growth last year. So its persistence would matter for the growth momentum in the region going forward. Our analysis show that a stronger AI adoption and faster adoption could actually lift our growth to above 4.6%, but a sharp pullback of this tech cycle could actually lower growth to about 3.1%. The concern is that all these risks, they do not operate in isolation and they could easily interact with each other. For instance, a prolonged energy shock could disrupt industrial supply chains and dampen tech investment, while tariff re-escalation would compound the drag on exporters already facing higher input costs. So given this highly uncertain environment, we think that macro policy priority is to preserve flexibility while standing ready to respond if the conflict impact deepens. For most ASEAN+3 economies, we still retain meaningful policy space, but responses need to be calibrated to the persistence of the shock. The objective is to prevent a temporary shock from turning into something worse, such as stagflation. Our assessment is that fiscal support should be targeted and temporary for highly exposed households and critical sectors, rather than broad-based price suppression via universal fuel subsidies, for instance. Monetary policy could afford to look through the initial energy price shock, but should be ready to respond decisively if this inflationary pressure broadens into core items. Over the longer term, we think there is a need to diversify energy and input sources to accelerate energy transition, strengthen our buffers, and preserve open regional trade channels. Now, let me take a step back from the near-term outlook and share more about our longer-term analysis on the region's transformation of trade and investment linkages. The broader question that we try to explore in this chapter here is how ASEAN+3's economic linkages have evolved over the past 2 decades and what that means for the region's resilience today. There are 3 key shifts that we want to highlight. First is this denser regional supply chains. Second, more regionally anchored demand. And lastly, reinforcing investment flows. The first shift, as you can see on this chart here, is the formation of denser and more integrated regional supply chains. The network maps show a clear transformation in supply chain architecture. Back in 2000, it was more Japan-centered, as you can see from the chart on the left. But by 2024, China had become the dominant supply hub in the region. But this is not simply a story of displacement. Korea and Japan, they continue to supply capital goods and high precision components, while ASEAN economies have taken on a larger role in mid-value manufacturing and digital services. The main point is densification rather than displacement. The regional production network has become more complex and complementary over time. For instance, more than 90% of exports between China and ASEAN are actually intermediate and capital goods, not final consumption goods. The second shift is on the demand side, and it is even more striking, as you can see. ASEAN+3 is now collectively the largest source of final demand in the world. This means that the region's growth is increasingly supported by its own consumption and investment, not only by producing for external markets. In other words, ASEAN+3 is no longer only a production base. It is also becoming a major demand center in its own right. Let's put some numbers to this demand story here. ASEAN+3 has surpassed the US as a source of global final demand. The region represented almost 28% of global final demand in 2024, as compared with around 23% for the United States. Even within the region, ASEAN+3 is now increasingly its own largest final demand market, surpassing the US. The ASEAN-China relationship illustrates this very well. China is now the single biggest source of final demand for ASEAN, while ASEAN is now the second largest source of final demand for China after the United States. So this demand linkage is increasingly two-way, as you can see. The third shift is investment flows, which mirror the shifts in trade and demand. More than 1/5 of global FDI is directed to ASEAN+3, and intra-regional FDI is nearing half of the region's total FDI stock. The investor base among this FDI within the region is also shifting, with China, including Hong Kong, China, becoming a more significant capital exporter. So putting all these shifts together, the region has moved from an externally oriented model to a more regionally anchored model. The old model was often described as the world's factory, something that we used to describe for the region, which means that in the old model, the region produced for the world, but intra-regional demand remained limited. But the new model is defined by denser supply chains, more inward anchored demand, and reinforcing investment flows. So what do all these shifts mean for the region? The first implication is more cyclical and conjunctural. We can see that business cycles within the region have become more synchronized over time. Our analysis show that since 2016, regional factors have become more important in driving growth fluctuations in the region. As you can see from on the chart on the left, if we drop the crisis periods, these regional factors now explain roughly as much growth variance as global factors. And this is not coincidental. Our analysis also confirms that GVC participation and FDI linkages are key drivers of this rising synchronization. The implication is that shocks now transmit more quickly through shared production and investment networks. The second implication is longer term and more structural. There's a structural trade-offs here behind all this transformation. The same deeper embedding in regional value chains that supports upgrading also increase exposure to a narrower set of partners and sectors. The chart map economies by value-added content and concentration risk. So as you can see on the x-axis, we have concentration risk, y-axis, we have value-added. What you can observe is that over time, many ASEAN economies, while they have moved upward toward higher value-added activities, but they also moved rightward toward higher concentration risk. Overall, deeper integration has brought clear benefits. It buffers external shocks, enables internal supply chain diversification, and supports productivity gains through value chain upgrading. But it also creates vulnerabilities. Regional shocks propagate more quickly, and concentration risk arises alongside value-added gains. So the policy question is really how to manage these trade-offs over time. On the cyclical side, we think that greater synchronization calls for sound domestic frameworks, enhanced regional dialogue, and preparedness for global shocks. For instance, strong domestic macro management nowadays is not just a concern for the country itself, but it's increasingly become a regional public good. On the structural side, sustaining longer-term growth requires domestic upgrading, diversification, and inclusion. Economies need to move toward higher valued activities, but at the same time try to reduce concentration risk and ensure gains are broadly shared. Let us now move to the final section on ASEAN integration. The question we want to explore in this part is how ASEAN can deepen integration and develop resilience in a more fragmented global environment that we are facing nowadays. Let me start with the basic observation, as you can see in these charts here. Intra-ASEAN trade integration has remained relatively shallow and modest. In the ASEAN panel on the left, as you can see, the actual intra-regional trade share, which is defined as intra-regional exports as a share of total exports from the region, has hovered around a low 20% range for decades. The ASEAN+3 and EU panels, as you can see in the middle and on the right, they show much higher intra-regional trade shares. We use a gravity model to show that ASEAN's intra-regional trade share is actually more or less aligned with its fundamentals. And these fundamentals include traditional determinants of bilateral trade, such as market size, geography and distance, shared border, common language, and historical linkages. However, if we compare ASEAN with broader ASEAN+3 region and the EU, we still feel that we can still see that intra-regional trade share still appears much lower. This suggests that beyond these traditional trade determinants, there might be there might be deeper structural constraints limiting intra-regional trade within ASEAN. And what we find is that one important constraint that limit intra-regional trade in the region is this limited trade complementarity among ASEAN economies. In other words, what ASEAN economies produce does not yet overlap enough with what other ASEAN economies demand. This slide here points to some of the structural limits we're talking about: income levels, production sophistication, and industrial capability. This chart here plots economic complexity on the horizontal axis and income level on the vertical axis. So it shows both production capability and purchasing power. So what we can tell is that ASEAN economies span a wide spectrum of income and industrial capability. While this diversity helps ASEAN economies to connect with the global economy, it actually reduces the degree of overlap within the region. On the demand side, lower and uneven income levels restrict the breadth of consumption and investment needs. On the supply side, lower production sophistication limits the range of intermediate and capital goods ASEAN can supply to itself. The result is weaker demand-supply alignment and shallower intra-regional value chain participation. This slide here shows that the investment gap within the region is even more pronounced. As you can see from the chart here, ASEAN's intra-regional FDI stock as a share of total FDI stock is only around 11.5%, much lower than the comparison groups shown in the slide. And this matters because we know that investment is the critical enabler of trade. There's a huge, large literature documenting how FDI can support bilateral trade through different channels. And our empirical analysis reinforces this point that FDI has a positive and statistically significant relationship with bilateral trade flows. So in many respects, as we can see, intra-ASEAN FDI is perhaps the weakest link in ASEAN integration. Without stronger cross-border investment, our efforts to strengthen trade complementarity or reduce policy friction will unlikely translate into much deeper integration. So given all this diagnosis, this diagram here lays out three mutually reinforcing pathways toward deeper ASEAN integration. The first pathway is straightforward, which is to realize current and planned trade integration initiatives. This includes easing non-tariff barriers, further liberalizing services, and reducing cross-border frictions. The second pathway is to leverage these global value chain linkages and all these incoming FDI flows to upgrade our domestic production capability. This would not only raise production complexity, competitiveness, and productivity, but would over time also support higher income levels and purchasing power within the region. And the third pathway, as we have discussed, is to promote intra-regional investment. And one way to promote intra-regional FDI is actually to push for more internationalization of our local firms in ASEAN. ASEAN has long been a hotspot for FDI inflows, as we know, and this is still true in the current environment. But what has been somewhat missing is stronger momentum for domestic firms to leverage these inflows for upgrading and to eventually develop local brands that will expand and compete regionally or globally. This is why we think firm internationalization matters for ASEAN's next stage of transformation. As you can see in the figure here, the structural leap is from export-oriented firms to internationally focused firms with a wider regional and global footprint. If ASEAN firms can expand into peer ASEAN markets and even to a wider region, they can naturally create investment flows with each other, strengthen supplier networks, and strengthen trade linkages that would reinforce regional interaction. Finally, this slide shows what these combined pathways could imply for intra-ASEAN trade by 2050. In the waterfall chart, you can see on the left, realizing current trade measures produces only an incremental gain from today's level. The larger gains come from domestic upgrading through GBC linkages and from strengthening intra-regional FDI. So with all three pathways advancing in tandem, our simulation suggests that intra-ASEAN trade could actually approach 40% by 2050, compared with only 25 to 30% under the baseline projection. The key takeaway is that deeper ASEAN integration is not only a trade agreement agenda, it is also a region-wide investment strategy focused on capability formation and regional investment linkages, pursued alongside continued trade openness. Now let me bring it together. In the near term, the Middle East conflict has shifted risks decisively to the downside, but ASEAN+3 entered this crisis from a position of relative strength. Over the longer term, our report shows that structural transformation provides a foundation for the region's resilience and growth. For ASEAN itself, deeper integration requires going beyond trade policy implementation alone. The priorities are to build domestic capabilities, leverage GBC and FDI spillovers, and strengthen intra-regional investment through ASEAN firm internationalization. With that, I will stop here, and I encourage you to read the full REO report for more details. Thank you very much.
Thank you, Haobin, for your insightful presentation. We will now proceed to the panel discussion. This next segment will be moderated by Ms. Catherine Koh from Emerald, who will guide the discussion with our distinguished panelists. Without further ado, let me hand the floor over to Catherine. Catherine.
All right. Thank you very much, Johnson and Haobin, for that presentation. Good morning, everyone. I'm Catherine from Emerald's Regional Surveillance Team. And it's a real pleasure for me to share the stage here today with our three distinguished panelists who will help us unpack a lot of the issues and challenges that Haobin has just presented. Let me just briefly introduce our panelists today. We have with us from the far end here, Mr. Manu Bhaskaran, the founding partner and CEO of Centennial Asia Advisors, who brings with him decades of experience on global and ASEAN macro trends and policy. Next to him, we have Dr. Chua Hat Bin, the regional co-head of macro research in Maybank Investment Bank, and he has widely followed on China, ASEAN, and financial market developments. And next to me here, we have Dr. Dennis Hu, a senior research fellow at the Lee Kuan Yew School of Public Policy, who brings with him the deep expertise in ASEAN economic integration and regional cooperation. Now, I would invite our audience here and also online to join us in the conversation. As you know, we have a very deep wealth of knowledge over here in our panel, and you can join the conversation by submitting your questions through the chat box. Now, let me start here with a broad question to all three of you. With so many shocks that Haobin has highlighted, he has pinpointed, Middle East conflict as being the most pertinent one. But there are also a lot of challenges that we're facing this year. We've got a new Fed chair, we've got rapid AI adoption, we've got tariffs coming back sometime in the middle of the year. What do you see as the single biggest risk facing ASEAN right now, and why? Perhaps let me start with Manu.
To add to the depressing list, actually, the thing I'm most concerned about is the bond market.
Okay.
So we've seen bond yields rising across developed markets, and there are knock-on effects in terms of risk aversion among global investors who then look at our regional countries much more rigorously. Indonesia is now under pressure because of some errors, I think, in policy, as well as this. So if there is some kind of unpleasant shock in terms of, say, the fiscal trajectory in the US, something goes wrong in the budgeting process, or something, you could get ruptures in the bond market and then feedback to us.
So from bond market, what do you think, Haobin?
Yeah, I think that would be the most recent concern, and clearly expectations of the Fed have shifted quite a bit. Now I think they're starting to price in a hike possibly later this year and then next year. And so a sudden turn, right? I mean, at the start of the year, everybody was even thinking that the Fed could cut rates. But clearly inflation is surprising and it could reach 5% in the US. So that's a bit of a concern, not just on the US fiscal deficit on the government side, but clearly a lot of tech companies have also been on a borrowing binge. Right? There's been a big step down. And the leverage of what were pretty good cash flow with the big tech is now a bit more stretched. And they are having to go to the market to borrow quite a bit to fund the data centers and so on. So that's a bit of risk. I think not completely priced into markets if things don't settle in terms of the Straits of Hormuz, then there'll be a major inflation shock, and that could invite all sorts of issues, not just in America, but also back here in ASEAN. We've seen pressures on ASEAN currencies to via the peso. So I think that's a bit that's one scenario that could be a bit uglier.
Dennis, do you share their concerns on the bond market?
Well, I do, but I have a different take, right? Because maybe I look at it from ASEAN as a regional institution. And I think the biggest risk right now is really a sense of complacency. If you look at ASEAN, it seems like, we've been through this crisis before, right? One of the reasons why the Chiang Mai Initiative was formed was because of the Asian financial crisis, and then we also have AMRO, right? But I think what was, the presentation earlier has highlighted is that ASEAN, the region, is going through a lot of structural changes, right? We talked about the need to double down on economic integration, which I think is important. But at the same time, we know that there are structural changes. The whole international order has really fractured. Okay? We can't depend on the US and China doing ASEAN can't hedge again between these two so that they can continue to grow. That doesn't work anymore, right? Whether we like it or not, our supply chains are deeply integrated with China, right? And the US is not going to accept that anymore. So the question now is, what do ASEAN companies need to do? Yes, we can double down integration. ASEAN has the infrastructure, all these regional agreements, RCEP, AFTA, but we know that there are implementation gaps in trying to address these things. So we talked about intra-ASEAN trade, intra-investment trades being really low. That's true, right? So what do we need to do to address this? If we talk to businesses, they'll tell you that there are 10, now 11 different markets, not a single regional space, right? And there are many challenges in trying to address that because really we're living in a poly-crisis era. They're compounding different kinds of crises, whether it's energy crisis, food, financial crisis, and we can't do it the same way as we can before.
Okay, thanks for highlighting that. So Dennis highlighted the poly-crisis era that we're living in. So let me zoom in on the most immediate crisis right now, the Middle East conflict. Let me bring you in on that, Habin. How do you see the Middle East conflict affecting ASEAN economies? As we've heard from Habin, the challenges are uneven across our economies. But what are the channels and what are the main takeaway that you have in terms of what worries you about this conflict?
Yeah, the impact is quite uneven. We were hoping that this crisis is resolved by the second quarter, because that blockade basically disrupts about 20% of world oil supply. And as you highlighted, it's not just about fuel price, it's not just about jet fuel, diesel, and so on, but also, the Gulf is also a big producer of bitumen, sulfur, helium, so all sorts of other components that affect many other parts of the economy. So I think the most immediate impact that we've seen in the numbers are the petrochemical sector. For Singapore and Thailand is plunged about 21%. So that's most obvious. This shortfall in the inputs. And starting to see some of the impact on the travel. I think the European travel all starting to turn quite sharply down actually for some countries. But then I guess we also, and then the construction companies are starting to see high diesel costs, bitumen costs, which affects the construction costs. Not every country is like Singapore, where they have stepped in to say that they will bear half the cost of the proportional increase. So this is, and of course, not many other countries also have huge pile of inventories to kind of buffer and cushion impact. So the dangers that the longer this drags on, I guess the risk of some kind of cliff effect for some countries. So far, the first Q GDP has held up pretty well actually across the board and surprised mostly on the upside, except in the Philippines. So it's quite remarkable. And but I mean, because I'm from the markets, and I think on the underlying side, not for this disruption, the demand side is actually pretty strong, right? Demand, so there is a positive risk that if this wasn't here, we will all be probably booming with the AI CapEx spending that's going on. And also, with all this data construction spend, with all this AI FDI that's coming from China, that showed up in many countries last year, including Vietnam, Malaysia, Thailand in a very big way. And as I pointed out, more than half, even for Singapore, more than half is coming from China. So you have an issue where there is this supply shock. You don't know how long it's going to last, but actually underlying demand, I think, is pretty strong, which is why some of the numbers are holding up fairly well. If this can be resolved quickly, I think there's upside risk to the economy. But it is not, it is not I don't think the demand side hit is as bad as yet for oil prices. Bear in mind that for the US, I think fuel spending on the basket used to be as big as 7%, but now it's down to about 3%, right? And the US is an energy exporter. And on the China side, they made so many moves towards renewable. They aren't as reliant as much. And then, of course, they've shifted away from coal, and coal capacity is just 50% from what I understand utilization right now. So most of us, you just start up the coal plant and you just live into the air, but the hit is not as bad. So if you've got two big engines, they're actually coping. I think on the demand side, it's actually a bit more positive.
So if we were to stay on that for a bit, to what extent would you see demand destruction coming in? If this conflict were to be prolonged?
Of course, the longer it is, it could be, but I think the longer it is, also the supply side also will kind of start taking care and responding as well. We've seen news of another pipeline being constructed, right, at breaking speed, on top of two major pipelines. And add all the three pipelines that can work at full capacity, they can take care of about 50% of about 10 million barrels per day. So that's one option. We've seen the step up on the non-OPEC producing countries as well. So we've seen the release of some of the inventories held by US, Japan, IEA. We've even seen America relax the sanctioned Russian oil, right, that was stranded. Apparently, I think Singapore bought some of that. So I think if you give a bit more time as well, alternatives, supply comes up and cushions the impact. So yeah, I mean, I'm hoping the best case is that some sort of oil tankers are starting to hit the straits, and then that would at least stop it. The oil prices from going to say 150 kind of a shock. But I think nobody's expecting to go back to pre-war levels.
Thanks, Habib. Manu, let me turn to you. So Singapore is facing this shock, Middle East conflict, but it is a small and highly open economy, and it's facing this shock on top of higher global uncertainty, geoeconomic fragmentation. There's a lot of structural issues as well. How do you see Singapore coping with the shock, and how can it continue to strengthen its competitiveness?
Yeah, so Singapore is vulnerable because we are very open. But vulnerable is not the same as not resilient, right? You can be vulnerable and take a shock, but if you can absorb the shock, because you have buffers in the system that help you absorb the shock, you don't have shock amplifiers like weak balance sheets or an unstable political situation that could aggravate the shock. Our buffers are strong. We have very strong fiscal position, so we can support the economy through cash transfers, support arrangements with SMEs, loan guarantees with SMEs like we did during the pandemic. So we have a lot of capacity for policy response, I think. But having said that, what worries me is that some of the damage from this 2 months, almost 3 months of war is baked in. And a lot of the inventories in the ships that have already left the Gulf have been drawn down. And some of the oil industry people are saying that if this crisis is not over, i.e. the blockade of the Hormuz is not reversed by early June, we could get this spike in oil prices that have been mentioned as a risk. And in that case, of course, any open economy, whether it's Singapore or Malaysia, Thailand, whatever, I think will take a very big hit.
All right. Then let me bring you in on this regional integration question. So Manu highlighted, Singapore is vulnerable but resilient. Do you think that's the same for ASEAN? And there's also been a lot of talks that the current global shocks that we're seeing, whether it's tariff or supply chain reorientation, has actually potentially accelerated regional integration. Do you share this view for ASEAN?
Yeah, before I answer your question, since I come from an academic institution as well, and it's related to the answer, is that we came out with a special issue last month looking at rethinking economic security in Southeast Asia, and that kind of addresses the question. I mean, for decades, I think ASEAN has placed this bet that openness, having export-oriented industries works for the region, and it did, right? But today, with this current scenario, the kind of structural changes that's needed, it's no longer relevant, or it's become a bit of a relic. So there's a need for the region as a whole to kind of recalibrate the approach it takes into economic security. You're right. I think and I've said that too, the one way to address these challenges is to double down on economic integration. But economic integration without strengthening regional resilience is a vulnerability. So they need to address what needs to be done to strengthen at the national level and also at the regional level economic resilience, right? And that's not just something that's state-driven by policymakers, but you also need to consider a much more human-centric approach. What needs to be done at the people level as well, right? Because many of these crises that we're seeing is going to affect many of us, right? Working class people, middle class people. What needs to be done? We need to look at maybe over the longer term things like social protection, issues of protection of workers, and other matters. Because we are going through some major structural challenges. I think we talked about the technological transformation. Yes, it's a good thing. It creates new jobs, new industries, but it also leads to a lot of displacement of jobs. Whether we like it or not, increasing a lot of workers, whether we are in the services sector or the manufacturers, are being displaced. So what are the challenges and needs for not just Singapore, but for the region to rescale their workers? We also have a wide development divide within the region. And that's bad for economic integration because people will get left behind. And we have now Timor-Leste, was just joined last year as our 11th member. That development divide is actually going to get wider. Now, initiatives within ASEAN, like the Initiative for ASEAN Integration, work plans that's been around for 20 years, it hasn't worked. It's not effective. So again, there's a need to rethink how we can narrow that development divide between the region. Climate changes, climate risk is another major change. This region is prone to natural disasters, droughts, typhoons. Again, that affects businesses and affects our domestic economy. What are the challenges and what needs to be done, both in the financial sector as well as at the regional level to address these challenges. So, like I said, we have a lot of long-term challenges. It's not business as usual. And policymakers, we need to really rethink how they want to address both economic security and resilience.
All right.
Yes. Yeah. I mean, I think that was quite interesting, all this economic integration, ASEAN+3. But sometimes I don't know, is it an objective? Is it positive? Because part of it is driven by the US-China trade war. And, as a result of the supply chains are just moving to ASEAN, trying to circumvent in part. So of course there'll be integration between ASEAN and China as a result. Does it make ASEAN more resilient, or does it make it more dependent? And really, if it's not driven by the final demand in ASEAN, and you're still coming outside of factory, but the exports go to the US, which seems to be shown by the data. Is that positive? I'm not quite sure.
Yeah, and the question is, do we need to choose a side?
Yeah.
Right? Do we need to choose
should not.
right?
Can I just add to that also? Early on, there's a chart about the densification of an intra-ASEAN. But what is the underlying push? Maybe when you look at consumption investment, it appears it's domestically driven. But what drives that investment? If that investment is driven by foreign direct investment, which is itself driven by AI capex in the US and elsewhere, that's not indigenous demand, right? So we are still actually, when you really drill down to it, we're still very much dependent on external factors, despite this appearance of intra-ASEAN integration progressing.
Yeah, and it's not easy to internationalize ASEAN companies. We know that. Even China, right? It started for automobile sectors. A perfect example. It first started with combustion engines, but the market's too competitive. but they made the right move, right, into EVs. So you're asking ASEAN companies to be multinationals like these big companies. It's not going to be an easy job to be done overnight. So what do we need to do to strengthen innovation? What are the things we need to do? Maybe facilitate.
But is even that enough? Because we are in a world where scale economies are so important.
Right.
And to get scale in ASEAN, we need to break down the barriers. But we all know that ASEAN Economic Community and so on is not really functioning as it was promised to, right? Because there's still non-tariff barriers and all that. So, do you think CIMB Bank can come in here and buy a local bank? Do you think a Singapore company can go into Thailand and buy over, some kind of big service? I don't think so. I think the resistance is, so you can't get scale.
Right. But let me challenge that thought a little on how, you think that we're mostly producing for external producers. I think Hong Kong has shown, over the 20 years, we have now increasingly produced more for ASEAN+3, if we take the broader ASEAN aggregation, right? Not just ASEAN. But in fact, ASEAN has also become a bigger source of final demand, even within the region, right? So would this vulnerability and this inherent tie to US still hold in your view?
Yeah, but at least I think there are two key capex and wholesale change in the infrastructure landscape that probably can increase intra-ASEAN trade. Of course, this reconfiguration supply chain is ongoing, but I see it as a diversion, because of this tariff war between the US and China. But one is clearly the AI boom, right? The infrastructure where there are going to be all these new investments. And like, for example, Singapore can't, don't have the energy, doesn't have the land, or the water to host these data centers. They're going to Malaysia and Johor, and that I presume over time we'll see a lot more trade in data and services, and presumably it also applies for Thailand. Second biggest ASEAN spot now for data centers. They'll be also doing more trade in data, and so because data and all that, I presume there is latency. Geography matters, right? So that makes sense for ASEAN. And then the second big driver is actually energy, right? As Dennis highlighted, energy security, where previously, Singapore would just import 95% 40% comes from the pipes, but a lot of it is just shipped in ships, natural gas, and so on. But if you want to go green, you have to start relying on solar, and that you have to buy from the region, right? And that's why Singapore has signed up contracts with Indonesia, with Malaysia, and that opens up a whole new area of trade in energy. And I think then the focus should be on building up the energy grid, the infrastructure within ASEAN, so that we can also buy from Laos and not from Thailand and so on. So I think that's two big drivers that intra-regional ASEAN trade can really take off in a bigger way than what we've seen in the past.
I like drinking coffee, for example. If you go to a supermarket in different ASEAN countries, even Singapore, Malaysia, whatever, you don't see the variety of coffees coming from different parts of Southeast Asia. Vietnam makes great coffee. So does Indonesia, Philippines, but we don't see that variety. Why is that? Why? Because there's still a lot of different kinds of non-tariff barriers and regulations that doesn't allow that facilitate more goods, if you want to encourage demand within ASEAN. But the logic for the ASEAN Trade and Goods Agreement, the ASEAN Comprehensive Agreement, the logic for that is to encourage, right, intra-ASEAN trade and investment, to create that consumer market, that investment market. But it's still not happening, right? It's slow, right? So the challenge now is what needs to be done, and I think we need to be a bit more radical here in trying to address that sense of urgency to remove whatever barriers there is. If you want to create that bigger market. So yes, the final demand market in ASEAN is growing, but more can be done, right?
All right. Let me just pause here for a bit and invite questions from the floor if there are any. Yes, Jim.
Could I just take off from the last point that Dennis made? And I'm very sympathetic to the arguments made by him and also just now in chapter 3 about how intra-ASEAN trade appears to have stagnated. But the elephant in the room, or the dragon in the room, if you will, of course, is that the reason why it has stagnated intra-ASEAN is because of the rise of China and the increased penetration of China as a counterparty to most ASEAN trade. Now, at the same time, I'm trying to reconcile this to the observation you made in chapter 2 about how consumption demand seems to be rising as well, both in ASEAN and in China. So how do we actually, or how does the panel think this rising consumption demand can be reconciled with this seeming stagnation in international trade?
Well, I have a couple of points to make on this. I mean, I think you're right. China is the big dragon in the room, and I think there are two trade shocks in the world today. One is Mr. Trump's tariffs, and the other is the surge of Chinese competitiveness. And it is true competitiveness, not just them subsidizing and manipulating things, but because of China's size, it just has a disproportionate effect elsewhere. And so ASEAN exports of intermediate goods have actually been affected by Chinese competition, Chinese displacement. Trade balances have shifted more and more in favor of China. And so there's this trade shock that we have to deal with. Secondly, one of that is because of Chinese underconsumption, right? Because of various issues, the real estate crash and the lack of social safety net and so on, the Chinese consumer is scarred and is not spending. And therefore, you have this, straight away, savings rate goes up, investment is the same, current account balance, of course, versus, expands, and China has a bigger surplus, right? So there's an issue of, I think, underconsumption. There's an issue of overconsumption in the US, and there's an issue of underinvestment in the EU. So these are the big imbalances in the world that are going to feed through to factors. But I think what we are affected most by is the Chinese stagnation.
But that's an interesting result too. I found it interesting that consumption is increasing both in China and this region. I mean, I thought China is going through, there's a negative wealth effect, right?
Yeah.
There's a debt overhang. People are not spending as much as they want to, or they're taking holidays within China rather than going overseas. And within this region, if the worst case scenario is that the energy crisis continues. I think someone mentioned stagflation. There will be a negative wealth effect here too. People will start to also consume less because they'll be worried about their salaries, they'll be worried about jobs. So interesting results. Maybe Amro can explain that to us.
Maybe we need to flash the chart.
Yeah, so I think in that part, yeah.
So what is driving that? You see, I mean, I don't get a sense that there's indigenous, Philippines demand for indigenously produced Thai goods, right? So what is actually these numbers, what do they actually show in real economic terms, day-to-day terms? I'm very puzzled, to be honest.
Could this be like a discord between the near-term outlook and also the longer-term structural transformation that's been underway? So to be fair, the chart shows the dimension across 20 years, right? So there is a growing middle class, there's rising income across China, and we have seen greater investment integration across the ASEAN+3 region. So the pessimism, and the concerns that Dennis highlighted is probably more related to a shorter-term outlook, which we do agree. It's definitely a bit more subdued, and there's a lot of downside risks. Are there any more questions on the floor?
Sorry, coming from Amro's side, maybe as one of the authors of the chapter 2 should I think it's true in the sense that what Kat is saying is right, in the sense that when you were looking at more than 20 years, 2000 versus 2024, right? Per capita income in China in 2000 was less than 1,000, right? Now it's almost a high income economy. Right? It's more than tenfold of increasing. So I think what is really interesting is that when you just look at from the final demand perspective, China's final demand is really the biggest source of final demand for most of our region's exports, with the exception of one or two countries, Cambodia, Vietnam, right? Thailand is in the middle, compared to US. In fact, since 2000, it has grown fourfold in terms of the size. But this is actually what we found is also that when we look at the reverse, so it's not just us dependent on China, it's also the reverse is also true. ASEAN is actually the second largest source of productivity, second largest source of final demand for China. So China is also relying more on us as a source of final demand as well. And we have grown by more than 3 times since 2000. The thing is that we don't really see this in the trade number because we are, again, more than 90+% of our exports are, in fact, 70 to 80% of our exports to China vice versa are intermediates. The remainings are in capital goods. So we don't see it like we don't export final goods. We don't export a final completed machinery to China. We export parts of that to China, assembled in China, consumed in China. And I think the same is also in a way applies to us as well, because we are part of a very integrated supply chain. So the first part of the story, the first shift, that we are much more complex production network, and the fact that we are also serving ourselves more. I think those two have to be looked at together in the sense that, it's not just direct us. The things that we can see directly are we export durian more to China than ever before. Those are the ones that get the headline, right? But I think most of the exports are actually in intermediate goods, and they get produced and assembled in various parts of the region that they consume domestically.
Can I just follow up on that?
Yeah.
So what exactly is China increasingly importing from us? You said intermediate goods, right? But what do you mean by intermediate goods? Is it lower value intermediate goods, or is it higher value intermediate goods? In other words, is China's development leaving space for our manufacturing sectors to really grow, move up the value chain, or is it just very simple stuff? And increasingly, the impression I get is China's ecosystem is so competitive that its component producers are displacing the exports from ASEAN in the higher value end of that intermediate good range.
Yeah, that's a very good question. I think from what we have seen is that the situation is rather uneven. When we look at ASEAN, the ASEAN 5 is slightly different compared to the CLMP. We are definitely looking at a lot more actually migration of middle to lower end intermediate goods to the CLMP. So I think there's a lot more there. But I agree with you. In general, there is that contestation, right? Of like where we want to produce and so on, and whether China itself can actually take in the entire supply chain and just produce in China itself. So what we have seen also is that in the most recent period, in fact, since 2020 and so on after the pandemic, is that China has also become the most important capital exporter for the region in many ways. Right? A lot of the exports in all the FDIs the region is getting are from China. So in a way, we are looking at it's structural. So the international investment position for China has been positive for a long time. But most of it was actually due to the official reserves. Right? In 2024, something happened. Even the non-official reserve component has became positive. So now they are becoming a structural capital exporter from the private sector as well. So I think we will see more of that coming, the production capacity of China being migrating out of China. Maybe it's not just from a purely competitive, like cheap, where is it cheaper to produce kind of perspective. It's also part of the geoeconomic realignment that is happening. Like Chinese companies want to export to the region and also to the rest of the world in a place where it's more neutral. So we are seeing some of that happen.
Yeah. Maybe if I could extend this discussion a little, we talk a lot about structural transformation that's happened over the last 20 years. What about the next 20 years? What are the longer term structural forces that you are seeing or expecting that would profoundly change the direction for, say, Singapore or even ASEAN as a whole?
Well, if we are looking at supply chains today, right, I think it's not a static model. We're seeing this great transformation in digital technologies, the use of AI. So, we talk about, say, moving your supply chains or diversity of supply chains. We need to understand that things are changing so rapidly. I mean, China, for example, is the largest users of industrial robots, more than any other country combined, right? They don't need cheap labor. They don't need human labor at all, right? So things are changing quite rapidly, and we need to adapt in this region. How do we adapt? Right now, it does look like we need to be more deeply integrated with China in terms of the whole production network. But is that the right direction? I think that's something that maybe all of us as policymakers, we need to rethink. And how do we diversify? How do we create more innovation? Even in AI, I was at a recent conference where someone from Japan said, we can't even compete with the US and China when it comes to language models of AI. We need to look at other niche areas, maybe physical AI, different types of AI. Find that niche, and then maybe we can build that. But right now, they're leading so many different areas of technology, whether it's manufacturing AI, we have to find that niche, and that's something that we need to think about.
That's my concern, you see. So I think in future it's going to be a competition between agglomerations, right? Where you have ecosystems that compete with each other. And in their different ways, the US has the Silicon Valley and all these different things. China has the Pearl River Delta. These are the agglomerations that are going to be very competitive because you have, within a confined area, incredible competition, producing very high quality components very cheaply. Prototypes can be turned around very quickly. How can we in this part of the world compete against that? It's going to be very difficult.
For me, I see that, quite glaringly, that there seems to be a global capex boom that's happening, that's materializing. So I would think that will also show on ASEAN. And a lot of the drivers for this capex boom is also geographic dependent. So the AI, the whole wiring of AI, data centers, infrastructure, depends on energy, water, play in geography. So I think that should drive up the ASEAN trade side and investment side. We're seeing that a big way in Singapore and Malaysia. And then I guess the other very obvious one, which is intrinsically geographic, is the green transition, right? Because previously we can just buy oil from somewhere else, but if you're really going green, then you really got to start buying from the region. Right? So that's a tremendous scope for trade, but also investment, in neighboring countries and all that. You have to, and the energy infrastructure is really in a dismal state right now. Right? So there's tremendous potential, and it's about changing the rules, allowing for that trade to materialize. Because not too long ago, 3-4 years ago, Malaysia even banned export renewable energy to Singapore. So I think there's two pretty big drivers on top of all this climate rise and all that, which is also, we say, semi-geographic. So you have to reckon that. I think chances are intra-ASEAN trade could take off in a bigger way, on top of what's been happening in terms of the FDI and supply chains.
So we need to focus on certain sectors where we think we have comparative advantage, whether it's green transition or other areas. I think that's the way forward, rather than to say, well, let's just keep it as the way it is, expect everything to be the same. And we're not the only emerging markets out there, okay? And this region, whether we like it or not, demographically is an aging population. Not just Singapore and Thailand, right? Other countries in Southeast Asia are also aging. You look at the ASEAN Vision 2045. It imagines everybody is still a young population. It's not, right? So there are other markets out there, whether it's in Africa, where they will increasingly begin to compete. And given the fact that there are reconfigurations of supply chains, nearshoring, friendshoring, Latin America is beginning to look very attractive particularly for American multinationals.
Actually, it's Turkey and Morocco and all that as well.
Can I?
It's no competition.
Sorry, maybe a last question.
Yeah, can I ask a follow-up question about Singapore? What is the less optimistic or worst case scenario you foresee for Singapore's future economy? Thank you.
Singapore seems to be quite a sweet spot. We thought actually there would be some impact, that will show up, and maybe it did for narrowly like petrochemicals, where it's plunged and all that. But so far, the AI boom is helping Singapore, electronic exports, data centers. The safe haven flows is also benefiting from Singapore. In March and April, we saw this huge, massive shift in deposits from Dubai and even gold that came to Singapore. So gold is running 9%. A nice problem to have because that's pushing interest rates down and supporting asset prices. And at the same time, Singapore's got this massive construction boom, which is driven also in part because by all these changes in climate, infrastructure, and that seems to be that's a long runway. So to me, what can go wrong is probably there's some shake-up in the political regime that you think can materialize, or the Fed really goes the other way, and tighten very sharply. That one I don't think Singapore can completely escape. And that will drive Singapore interest rates up. Some reckoning, in terms of Or you think that this crisis will lead to some geographical instability in the region, right? It's Indonesia or Malaysia. Not totally impossible. So back to Singapore.
So yeah, I agree with all that, and also of course trust and stability, have become a premium thing. That. But our cost structure has worsened. Now we can't even bake gardenia bread anymore. These are small things, but they are indicative. Well-known restaurants that really old on dying, right? Telling us something is not right. Second thing is that a lot of our growth is really driven by AI capabilities. One single thing. And if that can be sustained, fine. But I'm beginning to have my doubts whether that can be funded. So we pointed out, the big tech firms' cash flows are under strain. Increasingly have to borrow. Bond yields are going up. You've got massive IPOs that are going to suck liquidity out of the system. SpaceX alone is 75 billion. Anthropic and OpenAI are coming in. Some people are estimating about $175 billion of IPO cash call just from these three. You know what the total cash call from IPOs last year was? 75 billion. So just three companies going to draw 2.5 times. Yeah. So liquidity is going to come under strain. So you just wonder about AI capex, and then it's knock-on effects on you. But more fundamentally, this is a country that has thrived on globalization, the American Security Guarantee, and the norms that protected small states from being bullied. All these three things are at risk. So very fundamentally, we have big challenges ahead. Even though currently we have strengths and we can manage it, but in the long term, these things are going to be grinding on us. And we have to keep finding new economic models, be very adept, very skillful, very nimble at finding our way around it.
So I think Singapore wants to be a regional hub for everything, right? But the question now is with different types of technologies, you can see if a lot of multinationals are beginning to divide even their CEOs, right? The CEO may operate in Singapore, but their chief investment officer could be in Vietnam or Thailand. So they're trying to, because of becoming a very high cost city, right? So I think that's one of the things that, we may be losing our competitive edge as a regional hub because of all these different kinds of technologies available out there for companies not to just concentrate and put everything, all the regional headquarters in Singapore. So again, that's one of the things. But I'm going to try to be positive this time.
All right.
But that's based on Manu's point, but we can be a catalyst for growth in the region. I mean, Joe Grant is also having this point about geography. I think there's a lot of promise looking at the Singapore Johor economic zone, right? There can be a catalyst for growth. So one is regional, but with sub-regional and even at that level, these are two most industrialized countries in Southeast Asia. So there's probably potential for that for greater industrial integration. On a positive note.
On that very positive note, let me just recap. I think what we're seeing is definitely the old system that used to work for us is no longer there. And we really need to think very hard about how we're going to take ourselves forward, right? And notwithstanding managing all this short-term significant risks and shocks that we're going to face in the next year or so, but think longer term in terms of structural shifts, how ASEAN and even Singapore is going to position itself to whether write this as a catalyst to greater integration and resilience, or potentially also be more vulnerable to different risks that would emerge from elsewhere. On that note, thank you very much to our esteemed panelists and to all of you for joining us today. We look forward to seeing you in future events. In the meantime, please join me in thanking our panelists. Thank you so much. You're very, very.